Good morning, everyone. We are going to get started at about 11:02 to allow for the remainder of the participants that have signed up for the seminar to be able to join in. In the meantime, this is a question and answer seminar. So if you folks have questions or you have brought questions for this particular seminar, please go ahead and ask your questions today in the chat box to the left at any time. We'll answer as many questions that you have sent in as best as we can. We will start the seminar shortly. Well, good morning, everyone. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. Thank you for attending today's webinar, Taxes in Your Retirement Plans. Before we get started, however, I'd just like to put a disclaimer out there that Entrust does not provide investment advice or endorse any products or give tax advice. This particular seminar is just to answer some general questions you may have in regards to your retirement plans or the type of retirement plan that you are thinking about, or maybe some tax-related questions in regards to where do I report this on my tax return, or what's the concept of taxing a retirement plan. All the information materials are for educational purposes only. It is always best to consult with your legal or tax advisor for your specific situation. All parties are, again, encouraged to not only consult with your tax advisor or legal advisors, you may also even want to consider consulting with a financial advisor or an investment advisor if you are trying to think about or decide on whether or not a particular investment is right for you. Now, the Entrust Group has been around for over 35 years, focusing our efforts in the retirement space. And one of the main components of what delineates us from the rest of the competition is our education component. In other words, we try to provide as much education as we can on a non-biased perspective to tell you the pros and cons, as well as general information, specific information in regards to how tax law is written or how does the rule work, so that you can make an informed decision. Now, again, the agenda of today, I kind of started it a little bit, is talk a little bit about the Entrust Group. We are a major player in the self-directed IRA world, as well as the self-directed retirement space, because we do offer employer-based plans, such as your IRA-based SEP and simple plans, as well as the individual 401k plan. We're going to talk a little bit briefly about the investment options that are available in the self-directed world that hopefully would broaden your horizon in regards to what's available out there. Now, we do not offer investments, but the premise or the focus of what I'm trying to say is that there are other investments out there that are available to be held under your retirement plan. In other words, you can use your retirement plan assets to not only invest in stocks, bonds, mutual funds, but there are other types of investments that other investors avail of in the self-directed IRA platforms. What are the types of investments that are restricted from being held in an IRA world? And then we'll get into the popular questions. And then last but not least, if you're interested in opening up a self-directed IRA, we'll just spend a little bit of time on how to get that, how to open up one, and then from there we will answer as many questions as we can within the hour. All right, Entrust Group, again, as I mentioned earlier, has been around for about 36 years, focusing mainly offering a platform in the alternative investment space. What does that mean, alternative investment? Most financial institutions offer IRAs or retirement plans because they want to put the type of investment that they sell under those retirement plans. We're a little bit different. We do not offer any investments. We just basically custody or take control of the investment that you have under your IRA for record-keeping purposes, so that your account remains tax-deferred. In other words, we administer retirement plans, individual accounts, as well as employer-sponsored plans, again, that I mentioned, SEPs and Simples, as well as the individual 401k plan. We are a leader in the industry because not only do we educate our own people, our consumers, but we also educate our competitors. We do own a school called the IRA Academy, one of which is going to be held in October in Chicago. to acquire what we call the Certified IRA Service Professional designation, which is a designation through the American Banking Association, which not only us, but a lot of our competitors do have as well. Again, we've been around for over 36 years. We process around 12,000, 6,000 client transactions every month, and we administer over $3.2 billion in investor assets. What does that mean? The assets that they hold inside their retirement plan amounts to around $3.2 billion. Of course, that number changes on a regular basis. Sometimes it goes up, sometimes it goes down, depending upon the type of investment that they have. Our staff, one of the things that delineate us against the rest is that we have a knowledgeable staff. I personally train our staff using the information that we have through our school called the IRA Academy again, and even prepare some of our associates to acquire or maintain what we call their Certified IRS Services Professional designation through the American Banking Association. We also provide continuing education programs for practitioners such as real estate agents, real estate attorneys, CPAs, and other people related to the retirement space. We provide education on a national level, both local, in person, or events, as well as webinars just like this one. Again, last but not least, we do have a school called the IRA Academy that a lot of the financial institutions that you maybe have dealt with or deal with right now actually attend to get their training in regards to retirement plans. Now let's take a look quickly about what is a self-directed IRA. A self-directed IRA is a coined term in the industry that basically means that your custodian or your IRA provider does not offer any investments, but you, the IRA holder, has the option of choosing the investment yourself and bring to us so that we can administer your retirement plan to invest in such an investment which may not be offered in any other financial institution. Let me give you an example. Some people who are, reaching retirement age are saying, I cannot handle another market crash. Can I invest in real estate under an IRA? The answer is yes. But if you go to a financial institution like a bank or a credit union, that might not be the niche that they're into. They will offer you a CD, a money market account, or maybe even refer you to another individual in the branch that says, oh, this person can actually offer mutual funds, stocks, and bonds. Well, that was not the question that you had. Your question is, can I invest in real estate? There are providers out there, such as the Entrust Group, that offer a platform that allows for you to be able to hold that piece of real estate that you may be interested in under a retirement plan, because you no longer want to be in the world that you were before, such as stocks, bonds, and mutual funds. A self-directed IRA allows for you, the IRA holder, to direct the custodian to invest in the investment that you have chosen. Of course, assuming, of course, that the investment that you have chosen is allowable to be held under an IRA. We'll take a look at the restrictions, what investments are restricted from being held under an IRA. A lot of individuals are looking into the self-directed world because there's a greater opportunity to diversify their portfolio. In other words, not putting all of your retirement plan assets or putting your eggs in one basket. What does that mean? As you may have noticed that the stock market was at its highest point within the last couple of weeks, but also started to go down. What that means is if all your eggs were in one basket, that you would see the increase and fluctuation of your investment only associated with that portion that you've invested in that one sector of the investment world. There are other investments available for you which could broaden your horizon in the type of investments that you can invest in. In other words, you can also put some of your assets in real estate, maybe precious metals, or maybe some investment that you have been exploring that may have great potential because you know that particular sector of our society that may be a good investment for you. A self-directed IRA provider could basically facilitate that process for you. All investments are held in an account administered again by a trustee or custodian. We are a custodian that offers IRAs and will take custody of those assets. And because one of the premises in a retirement plan is, as long as you don't touch the dollars under your retirement plan, it's not going to get taxed until you take it out. So somebody has to take custody of those assets in order for it not to be taxed. The Entrust Group is regulated and governed by the rules set forth by various sections of the Internal Revenue Code. In other words, what do we do for you? Well, we report on your behalf. There's a yearly reporting on retirement plans. As an example, in IRAs, we have to issue an IRS Form 5498 on a yearly basis. If there's any money coming in via what we call a contribution, we have to report that to the IRS, as well as if there's any monies coming out, we also have to report that to the Internal Revenue Service. In other words, we fully facilitate the process of owning an account that is receiving preferential tax treatment because it's a retirement plan on your behalf, a self-directed IRA platform. Now, what type of investment options do investors invest in a self-directed world? Here are some examples. Single-family or multi-family homes, in other words, piece of real estate, commercial property, improved, unimproved land, precious metals, limited liability corporations. In other words, if there is a limited liability company that an individual may be interested in being a member of because they know that company has a great potential of growing, you can do that in an IRA, but it just so happens that you have to pick a custodian that would be able to facilitate that process and hold that particular investment. Offshore real estate, apartment buildings, co-ops and condominiums, notes, and many, many more. So in other words, the broad array of investments that are available out there are not necessarily offered by everybody or given an opportunity for someone to hold under the retirement plan. A self-directed IRA administrator, that's what they focus on. There are only 3 investment restrictions in the IRA world. Those are collectibles, which are any work of art, any rug or antique, metals that do not satisfy the criteria set forth by Congress with the passage of the Small Business Jobs Act of 1996, precious gems, any stamp or coin collection, any alcoholic beverage collection, and many more. This list could go on. Life insurance contracts also cannot be held under an IRA. But keep in mind, the life insurance contract that we're talking about here is an endowment contract. In other words, as an example, a term life insurance contract that's purely incidental, a benefit that would hit the beneficiaries of that particular contract upon the death of the IRA holder. Now, keep in mind, that would be a great racket to be held under an IRA, paying $15 a month for a contract that if a person dies, $250,000 goes into it as an example, not allowed under the IRA world. As well as last but not least, S corporations are not an allowed investment under an IRA because an IRA is a trust, and a trust cannot be a shareholder of an S corp. But beyond the 3 that I mentioned, you can consider any type of investment to be held under a retirement plan. There are restrictions called the prohibited transaction rules that, if asked, maybe we can go over that. But again, this is a Q&A section. I'm just giving you a brief overview of who we are, what do we handle, and what investments are not available. Here are some popular questions that we get asked. What are the tax benefits of traditional and Roth IRA? Are my IRA contributions deductible? Is the income generated by an IRA-owned property taxable? Here are just some of the popular questions that we get as an organization. Now I'd like to turn over the floor to you folks in regards to some of the questions you may have dealing with your retirement accounts. All right? I'm going to take a look at one of the first questions that I see here. I'm confused about the valuation of an asset in a self-directed IRA. I have a self-directed IRA with Entrust. The asset is in an LLC, which buys and sells real estate. Could you talk a little bit about the valuation process when if the value differs from the amount of the actual dollars in the LLC, bank account, and so on and so forth? Now, first let's take a look at what we call the fair market value. There is no direct definition of the fair market value that's been provided by the Internal Revenue Service. The only definition of fair market value is typically found in Treasury Regulation 1.2518, dealing with gifting. If you're going to pass on a piece of property from one person to the other, what was the amount that was given? And the IRS typically responds back that the fair market value is defined as what a willing buyer and a willing seller would transact a particular investment without any sort of coercion or any sort of pressure to buy a particular, what would it cost to sell it from one person to another? Now, there's many, many different ways to provide a fair market value, but the fair market value is used for many, many different things under a retirement plan, some of which may not be a taxable transaction or requirement, but some may also be a taxable requirement. For fair market value purposes, if an LLC owns multiple pieces of real estate, what would be the best way to get a fair market value of that particular entity that holds those pieces of real estate when it involves taxation? Let's first take a look at that. When it involves taxation, in other words, you're going to take a distribution, what would be the most prudent or most conservative approach in finding out what the piece of property is worth? Well, the most conservative approach would be, industry standard-wise, is what we call an appraisal. So typically a custodian would require an individual who invests in a property, whether it be directly or indirectly, to get an appraisal if there's a distribution. Why is that? Because the custodian is held responsible by the Internal Revenue Service, which is a faction of the Treasury Department, to report the amount that an individual should get taxed. So therefore, the entity that is going to be reporting that amount coming out of an IRA should accept the most prudent approach to figure out what an investment is worth to report that for tax purposes. Now, an individual could argue with that a particular amount, and that's between them and the IRS, but most custodians out there would ask for the most conservative approach, and that is typically an appraisal. There are other times when a fair market value is used as well, such as a fair market value statement or the value of an IRA at the end of the year must be reported to the IRS according to Treasury Regulation 1.408-6. Now, reporting to the IRS means that they are tracking the value of retirement plans in the United States. That doesn't necessarily involve taxation right away. Why is that? Because all they're trying to do is trying to put their arms around how much assets are in an IRA. If an individual has assets in an IRA at multiple locations, wouldn't you want to know what the value is of that IRA? And in some cases, in this case, in a self-directed world, the IRA holder was the one that chose the particular investment, so they should also provide the most accurate fair market value to the custodian so that the custodian can comply with their obligatory requirements with the Internal Revenue Service. But in some cases, the custodian will only require other forms of getting a fair market value, whether it be a real estate, a broker's assessment of what the market value is of an individual property at a particular time, or maybe other methods of acquiring a fair market value, whether it be a property tax valuation, something that some sort of assessment or logic has gone into valuing that particular investment. It doesn't necessarily have to require an appraisal because there's no taxation involved. There are other uses for the fair market value. Again, I hope I'm not, making you drink out of a fire hose, but I'm just trying to paint a picture for you on why the fair market value is so important. The fair market value for people who are over 70 and a half is also used to calculate what we call the required minimum distribution. The required minimum distribution is an amount that is required to be distributed from a traditional IRA, as an example, or a 401k plan for individuals that may have reached the magical age of 70 and a half. And that amount, if not taken out, it will incur a penalty. That penalty is 50%. That's Internal Revenue Code Section 4974. If an individual is required to take money out, in other words, another way to look at that is Congress is saying, I've allowed for you to have that money tax deferred for this period of time. When you reach 70 and a half, or in the year that you reach 70 and a half, it's our turn. You have to take out a small amount. You're going to have to start depleting that account. That is what we call the required minimum distribution. The required minimum distribution is a small amount required to be distributed, and if not, will be subject to a 50% penalty. The fair market value is what is used to come up with that minimum amount. The fair market value for the prior year divided by a life expectancy. Fair market value is used for that particular formula. In this case, if it's used to determine a minimum amount that must be distributed and subject to taxation, then the custodian may require a more prudent or more conservative approach in coming up with a fair market value. Then, we're going to go back to the first initial example. They might require what we call an appraisal, because that is what the IRS is going to take a look at in regards to what was required to be distributed that year to determine not only what's going to be taxed, but also what may have been subject to a 50% penalty if it was failed to be distributed. I gave you an earful in regards to fair market value, but I hope that paints a little bit of a better picture for you on why the fair market value is so important, because it's required by law in many different situations. First one, when somebody takes a distribution, the custodian has to report the right amount that's going to get taxed. Number two, sometimes the fair market value may just be an annual reporting requirement, such as the fair market value statement or an annual account statement using what we call an IRS Form 5498. And in some cases, the fair market value is also used for calculating certain things, such as the required minimum distribution, which is a taxable event. I hope that answers your question. Let's go to another question. Somebody has two questions. Let's first take a look at the first question. I converted my IRA, traditional IRA, of course, to a Roth IRA. Will the Entrust Group send me an IRS Form 1099-R to submit to the IRS? Okay. Anytime an individual has a taxable event, in other words, money coming out of an IRA, there should be what you call an IRS Form 1099-R that must be completed, and that's what the question was. If I converted my Entrust Group traditional IRA to a Roth, should I receive an IRS Form 1099-R? The answer is yes. The other question is that should IRS Form 1099-R be submitted to the Internal Revenue Service? And the answer is not all the time. And let me qualify what that means. If somebody takes a distribution from their IRA, in this case a conversion, money coming out of a traditional IRA, the individual will pay taxes on that, and it's going to be contributed to a Roth. We're only taking a look at the money coming out. The 1099-R will report the amount that is taxable. That amount should be reported on the IRS Form 1040 when an individual files their own individual tax return. The IRS Form 1040, line 15A again, should show the amount coming out of the IRA. And 15B says what amount of this is taxable. Right? So in other words, the 1099-R reports the amount to the taxpayer that money's coming out, and it is subject to taxation. And of course, it's not subject to the penalty because the individual is converting assets. All right. Now, if somebody's going to convert, yes, you should receive an IRS Form 1099-R. But do you need to file that with your tax return? The answer is no. The only time you need to file the IRS Form 1099-R with your tax return is if amounts were withheld from your distribution. In other words, if an amount was actually set aside and sent to Uncle Sam, so if you converted $100,000 and you had an amount of $10,000 sent to Uncle Sam already to pay taxes, that 10% should be reported on Box 4 of that IRS Form 1099-R. The Box 4 in the IRS Form 1099-R will report or validate or confirm with the IRS that $10,000 has been sent to them. That is the only time that an IRS Form 1099-R is required to be filed with your IRS Form 1040. Now, does the IRS know that money came out of your IRA? The answer is yes, because the custodian also sends information electronically to the Internal Revenue Service that says, hey, Uncle Sam, somebody took money out of their IRA. All right? So again, should you receive a 1099-R? The answer is yes. Should you file it with your taxes? The answer is it depends. It depends upon whether or not Box 4 has been completed or has been filled with any amounts that you may have withheld from a distribution. I hope that makes sense. Question number 2. I have an LLC with a sole member being my Roth IRA. do I still have to submit the tax forms on behalf of my LLC, or does Entrust send a fair market valuation to the IRS on my behalf? Okay, let's qualify this a little bit. If it's an LLC, the taxpayer must provide a value of the LLC in regards to what is the value of that LLC to the Entrust Group, so that we can complete the IRS Form 5498 as well as the fair market value statement. We do not value an LLC on behalf of a client, because keep in mind again, a self-directed custodian basically only takes custody of the assets. It's the IRA holder that chose the investment, so the IRA holder should provide that information to the Entrust Group. Article 4 of the IRS Form 5305, which is the trust document that created a traditional IRA as an example, in Article 5 on a Roth IRA, says that the IRA holder must provide the necessary information for the custodian to do their duties. In other words, you must provide the fair market value of that LLC. Now, are there any forms provided for the actual LLC itself? That is also needs to be filed if there's any sort of taxable event that needs to be filed for the LLC. But the Entrust Group only handles the retirement piece of it. The investment side has to be handled by the taxpayer themselves. Okay. Is tax-free investment income generated from self-directed IRA taxable? Okay. I hope I understand your question. In other words, if let's say you invest in a tax exempt bond under an IRA, if you invest in a tax exempt bond, that might not be a good choice. Why is that? Because anything coming out as an example of a traditional IRA will be taxed. So if you have a tax exempt bond under a traditional IRA and it has earnings that technically should be tax free, when it comes out of an IRA, it will be taxable. So to answer your question, a tax-exempt investment or tax-exempt investment will be taxable if you hold it under an IRA, because when you distribute it, it's going to be subject to a tax. Of course, the caveat to that is if the tax-free tax-exempt investment is under a Roth IRA and you've satisfied the qualified distribution criteria. In other words, you've had a Roth for 5 years and one of the four: death, disability, attainment of 59.5. If you satisfy those two things, everything under that Roth is tax-free anyway. So to answer your question, if it's a traditional IRA, it might not be a good idea. But if it's a Roth IRA, as long as the distribution is qualified, well then the distribution would be tax-free at that point. So we're mixing two different rules into one. So if you take a tax-exempt investment and you put it in a traditional, of course assets are going to be taxed when it comes out. Your tax-exempt investment may be taxed upon distribution. Here's another question. Does custodian allow for offshore investments such as real estate, agricultural holdings? It can. It can allow for it as long as there is a means of communicating with an offshore entity, and most individuals would set up with a legal counsel of that offshore account an entity that would be held accountable to provide fair market value to the custodian, also provide if there's any sort of gains from the sales of properties. That could potentially happen, but there has to be a mediator that provides that information from an offshore account to the to a custodian like the Entrust Group. There are also potentially reporting requirements that must be filed with the Treasury Department. If there is an account, as an example of an LLC type of organization that is that has a signer, which is a fiduciary, and doesn't necessarily have to be the custodian. There might be some additional Treasury reporting for those particular types of investment. But to answer your question in a general sense, is it possible to purchase offshore investments? The answer is yes, as long as the logistics would allow for it. Here's another question. Does bank balance need to be reported to the Entrust Group every year? Can we take that money and invest it in the stock market in an IRA? Well, every balance under the umbrella of an IRA must be reported to the custodian so that it is included in the fair market value. That's to answer your first question. Now, if an individual, let's say, wants to take that cash balance in their IRA and they want to invest it in the stock market, they may have to transfer that cash to another financial institution that is allowed to, number one, hold that securities as well as or sell securities, so that if somebody wants to purchase, investments in a stock market, they might have to transfer that to a financial institution that could actually sell it and hold it. In other words, let me give you an example. This is what a lot of people do. Some people might say, and I'd like to buy a rental property under my IRA. The Entrust Group would be the perfect place to do that. Of course, there's rent coming in. Let's say there's $24,000 in rent that have come into for that particular investment held under a checking account. Well, the individual might say, well, I'd like to take that $24,000 and invest it in the stock market. Well, what they would do is transfer that $24,000 out to financial institutions that could actually offer investments in the stock market, such as a broker dealer. They can transfer that $24,000 out, and then they can invest in the stock market at another financial institution. Once that money grows, they want to invest in a piece of real estate again. What happens is those investors bring that money back to the Entrust Group, and then voila, you've got the best of both worlds. Hope that answered your question. Here's another question. I have a self-directed IRA with Entrust and hold real estate in this account. If I sell an investment property after 1 year, will I be taxed at capital gains rate or ordinary income? Let me answer this question first, since that's the first question. If you bought the property outright, there is no capital gains taxation. Okay? So in other words, if you bought a piece of property, it's worth $100,000. You bought it using $100,000 of your IRA money, and now that property is sold under the umbrella of your IRA for $150,000. In other words, you had a gain of $50,000. First off, congratulations. That's a good investment. Short-term and long-term capital gains do not apply to this purchase and sale of property that has a gain. Just keep in mind, again, a retirement plan is tax deferred. In other words, taxation on that is deferred until such time those dollars are distributed. Now you have $150,000 in your IRA. If you take a distribution, that amount will be taxable only at the time of distribution. That amount distributed will be includable as taxable income for the year and will not be taxed at long or short-term gains. It's going to be taxed at regular income. So to answer your first question, if you hold a piece of real estate, you sell that piece of real estate held under an IRA, the gains will not be taxed. Okay, let's take a look at the second question. I was told that my self-directed IRA would be taxed on the property at ordinary income rate when I start withdrawing funds at the age of 59.5. Well, it'll be taxed at regular rates anytime, before or after 59.5. At 59.5, you will now not be subject to the 10% penalty. But if you take a distribution before 59.5, not only will you be subject to the tax, but you will also be subject to an early distribution penalty, potentially. You know why I say potentially? Because there are exemptions to the 59 to the early distribution penalty. Now here's the next question. If this is correct, this real estate property investment is taxed at a very high rate. Well, that's the way the Congress created an IRA. So if you buy, let's say, a stock and you purchased it and it's sold after 12 months, it is not taxed the same as a stock that was purchased and sold outside of a retirement plan. It is just taxed at ordinary income. Right? There's another question. What are my options? What other options are available to only pay the capital gains on this property versus ordinary income? Well, you can't just pay the tax on the gains on the property. Keep in mind, if it's a traditional IRA, none of the assets have been taxed before. So if you bought a $100,000 piece of property of assets that have never been taxed before, you can't just say, I want to pay the tax on the gain. That's why everything is taxed at regular taxable income. Unfortunately, there is no option to do that. So, We only provided fair market value evaluation of property owned, but not sure what to do with the other accounting for expenses and income coming in for the note or notes the LLC holds. Is it too late to provide interest something for 2017? Now keep in mind, gains and losses are suppressed. In other words, any gain is not taxed. Any expenses is also not deductible. So basically, the fair market value that is provided to the Entrust Group, number one, it's just used for reporting purposes, unless, of course, the individual takes a distribution. This is in an account that has expenses. Let me give you an example. Mutual funds have expenses. Those are not deductible on your own personal income tax return or even deductible for any sort of distribution. Same goes with a piece of property. If you own a piece of property under a retirement plan and those expenses are paid from assets in a retirement plan, those assets have never been taxed before. So if somebody uses that as an expense, it's also not going to be deductible. So in all fairness to that account, which is tax deferred, there is no capital gains or short-term, long-term capital gains. You don't have to worry about that. Their expenses are also not deductible because assets, again, have never been taxed before. So the only amount that's going to get taxed is the money coming out. I hope that answers your question. Next question is it necessary to determine fair market value on an annual basis if you're not affecting the withdrawal from direct assets? Yeah, you still have to report the fair market value. And the reason for that is it's required by law. The way Congress determines whether or not their legislation is working is based out of the increase or decrease in the valuation of investments that are held in retirement plans. That is what they use to determine how they're going to tweak the law to make it better or, to suppress parts of the law depending upon whether or not it's working too well. So the fair market value always has to be provided on an annual basis because your custodian, whether it be Entrust Group or another entity, is required to provide that information. Take a look at some other questions here. What is UBTI and is it applicable to the sale of an apartment building held by an LLC owned by, I lost the question here. What is UBTI? Okay, here we go. What is UBTI and is it applicable to the sale of an apartment building held by an LLC owned by a 401k plan administered by a custodian? It doesn't have to be Entrust, it can be somebody else. What is UBTI? Okay, let's explain what UBTI is. UBTI is what we call unrelated business income tax. Unrelated business income tax. You actually spell it as UBIT, unrelated business income tax, but the IRS sometimes calls it UBTI, unrelated business taxable income. All right. An IRA is what we call a tax-exempt entity. In other words, earnings on that is not taxed. Another term for that is also it's called tax-deferred earnings, which means that the earnings do not get taxed until such time that they distribute it. And if it's a Roth, the assets may not be taxable if an individual satisfies certain criteria. Uncle Sam says if you're owning an entity, like a business, like an LLC, which is what part of the question, owned by a retirement plan, that entity cannot have a competitive advantage over another entity doing the same thing. So in other words, if an individual invests in an LLC that is a business of a laundromat, as an example, that LLC that owns that laundromat cannot have a competitive advantage over another LLC outside of a retirement plan that does the same thing. So you can't just say I'm only going to charge $1.50 to wash a shirt because I don't have to pay taxes on it. Uncle Sam says both entities have to pay taxes. In other words, an LLC under a retirement plan may be subject to income tax, and that's where the unrelated business income tax comes into play. The taxation of an LLC under a retirement plan is taxed at a higher rate. It is taxed at trust tax rates. There's a publication 598, that talks about this. Now, there are some incomes on an LLC that may not be subject to tax. There are exempt income. So in other words, some individuals may only own pieces of real estate that basically collects rental income. Let me give you the list of incomes an entity may receive that is not subject to tax. Rental income, royalties, dividends, interest income. Those are types of incomes that are not subject to tax. So in other words, some IRAs may have an LLC underneath as an investment, but it doesn't have to file a tax return because the income that it earns is not taxable income. If the income that the entity receives is defined as income received from a trade or a business, right? In other words, the entity is actually a business being ran under a retirement plan, then that entity has to file a tax return. The tax return that has to be filed is what we call an IRS Form 990T. IRS Form 990T. You can Google it, IRS Form 990T. The IRS Form 990T has to be prepared by the IRA holder or 401k trustee, and, of course, with the assistance of a tax advisor if you don't know how to complete one of those, and has to be signed by either the trustee of a 401k plan or the custodian of an IRA. So in other words, to answer your question, what is UBTI? UBIT or UBTI is income that may have been received by your IRA that was derived from a trade or business. If it does receive that, in this case, if it's taxable income, it has to file an IRS Form 990T. But if it's just a piece of property purchased and sold, gains, no taxation on that. If it's rental income, no taxation on that. If it's royalties based on mineral rights, as an example, no taxes on that. But if the LLC is a property development company, as an example, that basically conducts business on a regular basis as a regular business, then you might want to consult with your tax advisor to determine whether or not that income being received is subject to tax, called UBIT or UBTI. And again, the IRS form that is filed is the IRS Form 990T. Next question here. Can you have a solo 401k by opening an LLC for yourself to show that the IRS you're self-employed and you file LLC taxes with zero income and zero expenses? The answer is yes. You could establish an LLC, but keep in mind, establishing an LLC means you should have a business. Contributions to a solo 401k is derived from a percentage of the income for that business. But if you don't have any income or expenses, well, then there's nothing, there's no taxation. But can you establish an LLC? Yeah, but hopefully you have the intent of having that business be ran like a business at some point. Now, the next question is, which you didn't ask, is can I fund that with a rollover from an IRA? The answer is you sure can. A lot of people are doing that as well. Next question. Does an LLC held within a self-directed IRA have to file an annual federal or state tax return? That would be something you would want to consult with a tax advisor in regards to whether or not that entity has to either file, one for itself, or in some cases has to pass on the income that it earned to the members. And in this case, it might be an IRA. So that would be a good tax advisor question for you, right? Especially from a state perspective. We have an Entrust IRA and open a self-directed LLC, checkbook account. The LLC holds secured notes and rental property with the income going directly into the checking account, and all expenses are paid from the checking account. What does Entrust need year-end for this checking account? We only provide the fair market valuation on the property owned, but not sure what to do with the accounting for expenses and income on the note. And is it too late for something to provide to the Entrust Group? We just need the net amount on that checking account. In other words, from the income that it receives And expenses, what is the net? What is the balance on that account at the end of the year? That's the only thing that needs to be included with the values of the property to come up with one fair market value for that IRA. So to answer your question, we just need the balance on that account. When can I collect from a self-directed IRA? I don't know what that means, or maybe you're asking when can you take a distribution in IRAs? You can take distribution at any time. Depending upon the IRA that you have, it may be subject to tax and potential penalties. Also, depending upon how old you are when you take a distribution. Right. If you have an investment such as real estate and the appraisal amount fluctuates from year to year, is there any tax implication to that? The great news is no. If you have an investment in a retirement plan, let's take a look at a mutual fund so that you can see the comparison on how it's treated. A mutual fund may be $100,000 today. Let's say I'm just using that as an example. Let's say you have $100,000 worth of mutual funds, and then the market drops. Now you only have 75. There's no tax implication on that fluctuation. Same as if you have real estate under a retirement plan. If that piece of real estate it goes up, there's no tax implications. If that piece of real estate goes down, there's no tax implications because you haven't distributed it. The taxes on retirement plans only come into play once you take it out. Once you take it out, the tax treatment of that will be determined whether or not you have a traditional or Roth IRA. If it's a traditional, of course, the gains on that will be includable as taxable income. If it's a Roth IRA and you've satisfied the qualified distribution criteria, having a Roth for 5 years and one of the three, 59.5 death disability, or as well as up to $10,000 for first-time home purchase, well then that amount will not be taxed upon distribution. Can I get a mortgage by buying property with an? Okay, let me see if I understand the question. If somebody doesn't have enough money in an IRA and they would like to buy a piece of property, can the IRA get a mortgage? And watch my wording here. It's not you getting a mortgage, but it's the IRA. Can the IRA get a mortgage? The answer is yes. The mortgage that it gets has to be what we call a non-recourse loan. And the reason why it has to be a non-recourse loan, let me explain what a non-recourse loan is. The lender cannot have any other recourse but to go after the IRA and the property within the IRA. They cannot have a recourse to go after the IRA. Here's the reason why. One of the stipulations in the prohibited transaction rules is that the IRA holder themselves cannot extend credit to the IRA. So let's say you want to buy a $200,000 piece of property and there's only $100,000 in there. The IRA has to be self-contained, self-sufficient in acquiring a loan from a lender, a non-recourse loan lender, so that the credit is actually being extended by a third party to the IRA and not you, the IRA holder. You can't say, I want to guarantee that loan that if the IRA fails to make payments, I will make payments on that. You can't do that. You're extending credit to your IRA. That's why it has to be a non-recourse loan. With that said, the non-recourse loan lender has different underwriting guidelines, such as the property has to produce enough income to be able to pay for itself. In other words, if it has to produce income, most of the time, lenders will only say we will only lend to an IRA if it is an income-producing property, such as a rental property. Some of them might also try to mitigate risk by saying we will only loan if the property, provide a loan if the property is a multi-dwelling property. In other words, multi-family dwelling. Why is that? Because there's more income, more potential to be able to be paid back. Last but not least, one of the biggest difference with a non-recourse loan provider is that the down payment or the loan to value is much higher. I've seen it at 50-50. In other words, you have to have skin in the game. The IRA has to have enough skin in the game in order for that lender to lend. I've seen it as high as 70-30. But to answer your question, can you buy a piece of property using your IRA assets and have a mortgage? The answer is yes. It would have to be a non-recourse loan, however. There is a lot of non-recourse loan providers out there. Some of them are banks. Some of them are hard money lenders. But there are non-recourse loan providers out there. All right. This is just purely for education. Again, we're not selling the Entrust Group here, so just if you have any questions on that, pursue it further. All right. Can you buy with your IRA a portion of an LLC that owns real estate investment? In other words, can your IRA be a member of an LLC? The answer is absolutely. The LLC, however, cannot, your IRA cannot engage in a prohibited transaction. In other words, you cannot engage with an LLC that is owned by a family member or owned by you personally. That's 50% or more. So in other words, if you want to buy into a particular business, you might want to consult with your tax advisor to make sure that whoever you're interacting with is not a disqualified entity or disqualified party. So to answer your question, yeah, an IRA can invest a portion of an LLC that invests in real estate. Absolutely. As a matter of fact, a lot of individuals partner together. They form an LLC, and certain percentages are contributed to that and funds that LLC to purchase real estate. Absolutely. That is a good thing to do. But again, talk to your tax and legal advisor to make sure that you don't run afoul by not knowing some of the rules. All right. Here's another question. I will receive my IRA funds at the end of the month and wonder if I should set up the account with Entrust prior to receiving the funds or wait until the money is in hand. I'm not quite sure what that question is. I will receive my IRA funds at the end of the month. Where is that coming from? If I should set up an account at Entrust prior to receiving the funds or wait until the money is in hand. If you have monies that are distributed from an IRA, as an example, made payable to you in hand, you can roll it back to another IRA within a 60-day period. But if all your intention is to move your IRA funds out of one institution into another institution, then I would highly recommend that you just conduct a transfer. A transfer does not have any distribution at all. It's not even reported to the IRS. What it is that as long as it's being transacted within two financial institutions, the money could be sent directly from one financial institution to the other. Therefore, Uncle Sam says, if I can't tax anybody, forget the paperwork. So depending upon what you're trying to do, just to answer your question, if you're going to receive money, can I put that money back into an IRA? The answer is you can. But it has to be done within 60 days. And you are also limited to only doing one of those in a 12-month period. So why use up that opportunity when you can actually just conduct a transfer, which is unlimited? I hope that answers your question. Here's another question. Are self-directed IRA fees paid to the trustee deductible? If it's paid out of your own pocket, the answer is yes. But if it's deducted from the account, the answer is no. There's a revenue ruling 84-169. Don't quote me on this. It's around 19. This was actually a ruling already. Are administrative fees deductible on your tax return? And the answer is it depends. If it's paid out of pocket, in other words, paid out of your own pocket and was not deducted from your IRA, of course it's deductible, assuming, of course, that you file an itemized deduction. But if it's paid out of the IRA, it's not deductible. Because keep in mind, the assets that was used to pay the fees has never been taxed before. So if it's paid to somebody else, whoever receives it will be the one to pay the tax. But of course, some people don't want to use their IRA assets because it depletes your assets out of your IRA. Some of them would rather pay out of pocket. Again, if you pay out of pocket, then it could be deductible. Speak with your tax advisor, right? Can the LLC borrow money from a bank to buy an investment property? Assume LLC is owned by your LLC. To simplify the question, can an LLC owned by an IRA borrow money? Again, it has to be a non-recourse loan. The non-recourse loan may incur also additional taxation. Why is that? As I explained in the initial other question, can you use money to borrow? Yeah, you could. But here's another additional issue. The IRS says if you borrowed money to purchase a piece of property and it has income, the proportionate share of the income received by that IRA, which would otherwise not be taxable because it's rental income, as an example, will now be taxable. Why is that? Because you used money that wasn't yours in the first place. We give you an example. Somebody has $200,000 piece of property they have an eye on, and they have $100,000 in their IRA. They borrowed an extra $100,000 from a non-recourse loan lender. In our scenario, 50% of the purchase of that property that was used came from the IRA, and 50% was borrowed. Uncle Sam says if that property earns $10,000 for the year, the first $5,000 of it, which is 50% of whatever the income is not taxable because that was purchased using your IRA money. The other $5,000 that it earned will be subject to tax, called UDFI, unrelated death financed income. That is to be filed on the IRS Form 990T. There is a line item there that says unrelated debt finance income. That amount is includable as taxable income for the IRA when the IRA files its own tax return. Meaning, if you don't have a tax identification number, employer identification number, EIN, for the IRA, I would highly recommend that you get one, because that EIN is required to be is a required number for the IRA to file its own tax return using the IRS Form 990T. So to answer your question, can an IRA borrow money? The answer is yes. I'm going to extend the question a little bit. Is the income earned from that property that was purchased using borrowed money taxable? Only the portion that was associated with the amount that's borrowed will be taxable. And, of course, you're going to be making payments to that. And if the payment, more and more the principal will be owned by the IRA, so the percentage ratio will change. Publication 598 says, take an average of whatever, the increase is on the ownership of that IRA to determine the amount that's subject to the, associated with the loan to determine the amount of income that is going to be taxed. All right, so there's a lot more to borrowing, but you can. A lot of people accumulate a lot of wealth in a retirement plan using that concept, but there is taxation involved. Can you reiterate your earlier comment? At 70 and a half years, I need to start taking distribution. You mentioned that it was the fair market value divided by something, but I missed it. Okay, that's a good question. What a person in traditional IRAs, SEP IRAs, simple IRAs, and if you dig up your IRA document that should have been provided to you by your custodian or ask for one, it's called the IRS Form 5305. In a traditional IRA, SEP IRA, simple IRA, when you reach the magical age of 70 and a half, in other words, you're going to turn 70 in the first part of the year, you're going to turn 70 and a half that year. You are now going to be required to take a minimum amount. It's called a required minimum distribution. Failure to distribute that amount will mean that any amount that was a shortfall of what you should have distributed will be subject to a 50% penalty. How you calculate that for the year is you take the prior year-end balance. Right? Prior year-end balance. In other words, if you're calculating RMD for 2018, you use 2017. And you divide that by what we call a life expectancy multiple. And the life expectancy multiple can be acquired through a publication. I'm going to slow it down here because you're probably going to be writing this down. It's publication 590B. Publication 590-B is the distribution portion of an IRS publication dealing with IRAs. Publication 590B has a table in the back. It's called the Uniform Lifetime Table. The Uniform Lifetime Table will have a life expectancy multiple associated for every age starting at age 70. The multiple that you would use to calculate this required minimum distribution is the age that you would attain as of your birthday. In other words, if you turn 70 and a half this year, but you are going to turn 71 this year, or if you're not going to turn 71 this year, then you use age 70, then you use the age 70 in that table. You divide last year's balance by that multiple, and I believe the first year's multiple is 27.4. And whatever the result is your required minimum distribution. For the first year alone, an individual is allowed to postpone that distribution up until April 1st of the year following. So if this is your first year, you have until April 1st of next year to distribute that amount. But you need to be aware that if you postpone your first year's distribution to the following year, you have another distribution in that same year by December 31st. So what's the takeaway here? You can either distribute it by the end of the year or wait until April 1st of the year following, but you have two the following year. That is something that you might want to talk to your tax advisor with, because that amount is includable in your taxable income for the year. So depending upon when you distribute that amount will determine the amount of your taxable income for the year. So I hope that answers your question. Prior year end balance divided by the life expectancy found on the Uniform Lifetime Table found on the back of publication 590B. Right? A lot of information. If you have any further questions, just please put it on the list. For a solo 401k plan, do you enroll with the EFTPS as an individual or a business in order to make the 20% mandatory federal tax withheld payment on a solo 401k distribution for a 60-year-old man? For a 401k plan, number one, you should get it's the plan's own EIN number. And one of the reasons for that is a solo 401k plan, individual 401k plan, owner-only plan. Those are the terms associated with the same type of plan. They just have different names. The IRS calls it owner-only plans, right? Whether you be a sole proprietor or whether it be you're considered a business, you should get its own EIN number, right? To separate that from the EIN of your business. A lot of employers make the mistake of using the same EIN that they filed a tax return for their business, whether they're a sole proprietor or an actual LLC or partnership, whatever it may be, right? They use that same EIN to file additional filings that may be required for your 401k plan. That could be very confusing to the IRS because they can't delineate what you're reporting to them. So the IRS says if the 401k plan, which eventually would have to file a tax return, once the assets reach the level of $250,000, it's called an IRS Form 5500 EZ, right? It is best for that business to get a separate EIN number for the plan. That EIN number will be used on that IRS Form 5500 EZ to file a return. And also, you know, when the question says, do you file an individual or a business, it's one and the same. Uncle Sam, whether you're sole proprietor or whatever entity you are, that EIN number, regardless of what type of entity you are, that EIN will be the EIN used for distributions from that 401k plan, so on and so forth. All right? I hope that answers your question. I had real estate in a self-directed traditional IRA. I have since converted that to a Roth IRA. I paid all the necessary taxes. Can I sell or use the property without any tax consequences? All right. Just to understand your question, I'll repeat it back. Self-directed IRA, traditional IRA, that traditional IRA was converted to a Roth. So in other words, in the year of conversion, that amount was taxable. In other words, so that it could be contributed to the Roth as a converted amount. I hope you also filed an IRS Form 8606. The IRS Form 8606 Part 2 keeps track of the assets that have been converted so that the basis or the amount that has been taxed already is being tracked, right? Can that amount be sold inside of a Roth IRA, and are there any taxes involved with the earnings if it's sold under the Roth IRA? The answer is gains, again, are not taxed inside a Roth IRA or a traditional IRA because those are all deferred. However, if you convert it from a traditional to a Roth IRA, the earnings on that investment, if you're going to distribute it out of the Roth IRA, must satisfy the qualified distribution criteria in order for the earnings to be tax-free. All right? So if you're going to sell the property inside the Roth and it's going to stay in the Roth, there's no taxation there. But if you decide to distribute it, the taxation there and on those earnings, right? It's the growth above what you converted will be subject to a tax if you haven't satisfied the qualified distribution criteria, and will not be subject to a tax if you have satisfied the qualified distribution criteria. I think I mentioned this earlier. I'm going to mention it again. You must have had a Roth for 5 years. The clock starts ticking as of January 1st, for which any contribution you made to a Roth. So in other words, if you've made a contribution to your Roth IRA 4 years ago, well, your Roth is 4 years old as of January 1st of that year. And once you hit that 5-year clock, you've satisfied one half of the criteria. Now the only thing you'll be waiting for is once you turn 59 and a half, die, or become disabled, or if you want to take up to $10,000 of the earnings out after you take the conversion amount out. In other words, once you tap into the earnings, up to $10,000 of that can be used to purchase a first-time home. In other words, you've never owned a home before, right? But if one of the three is satisfied, you're 59 and a half and you've had a Roth for 5 years, everything in that Roth is tax-free. But if you haven't, well, the earnings will be taxed. Hope that answers your question. When one reports the fair market value of an apartment building, does one reduce the fair market value by the mortgage? After all, when you sell the property, the IRA will only get the amount to distribute. The fair market value for the IRS Form 5498 is the complete fair market value of the property, right? In other words, because the mortgage is payable for that property. It is included. It is the value of the investment. The fair market value upon distribution will be dependent upon how much you actually received. So, in other words, when you report the fair market value upon distribution, if the amount was first used to pay off the mortgage, that has to be deducted from what you actually received as constructor received on the 1099-R. So therefore, you will only be taxed on what's received, but not the actual full fair market value of it. Right. I hope that answers your question. If a contractor is paid more than $600 by Entrust for work on an IRA, whose responsibility is it to set a 1099 miscellaneous? Does the IRA owner have the responsibility? The answer is yes. In a self-directed account, keep in mind again, Entrust did not provide the investment. It's the IRA holder who acquired the investment and availed of Entrust to be able to facilitate the process. So whoever it is that is, preparing any tax returns for that IRA will be the one that you would have to hire, or you personally need to provide that 1099 miscellaneous. It will not be the Entrust Group. I want to transfer rental income to an IRA. Is that money transferred from bank account to Entrust, or can it go directly from bank to IRA? Let me qualify that question. Is the rental income for is that an IRA-owned rental piece of property? If it's an IRA-owned rental piece of property, it'll just be a transfer from one IRA to another. But if it's rental income from a rental piece of property outside of an IRA, and you wanted to move those earnings, that is going to be considered what we call a contribution. If you want to contribute the earnings that you have in a rental property into an IRA, that has to be done via what we call a contribution. It is 12:10, and tell you what, it is 12:10, and this seminar was only intended to last for an hour long. If you have any further questions, please do not hesitate to contact us. And I'm going to quickly talk about how to get started with the Entrust Group. If you're interested in setting up a self-directed account with the Entrust Group, it's a 3-step process. You open up an account with the Entrust Group. You fund your account with either contribution or, for the most part, a transfer from an existing IRA to another financial institution to the Entrust Group, or a direct rollover from a 401k plan as an example. You instruct us on what asset or what investment you want to invest in, and then voila, you've got a self-directed account that's been fully funded and invested in alternative investments. To contact us, you can get started by going to www.theentrustgroup.com/open new account. Of course, it's going to need some personal information, a digital copy of identification that is required by law, and credit card information and how you want to pay the fees. Right now, we do have a promotion that if you set up an account at the Entrust Group, we will waive the initial setup fee of $50. So take advantage of that, and that is valid under April 17th of 2018, which is tax return time. It can be done as easily under 10 minutes. All right. We thank you for attending today's course. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. Again, if you have any further questions, please do not hesitate to send your questions to us, and we're more than happy to try to answer those questions for you. Again, thank you for attending today's seminar, and we look forward to having you again on another Entrust Group webinar. Have a great day.